Welcome to the Deep Dive. Today we're digging into Acuity Brands, ticker AYI. They just had their fiscal 2025 fourth quarter and full year earnings call, October 1st, pre-market.
Yeah, and this is a really important one to watch. Acuity's been on this journey, trying to shift from just being a lighting company.
A traditional kind of cyclical lighting business.
Okay, into more of an industrial tech player.
Yeah.
Think controls, data, smart buildings,
Yeah.
that whole intelligence layer.
And this call really seemed to give some concrete proof points on that transformation, especially around their Acuity Intelligent Spaces, or AIS, segment.
Absolutely. The QSC acquisition is central there, and this call showed it seems to be integrating well and really starting to pay off. The market certainly reacted positively.
It definitely did. Stock closed up over 5%, and the volume was huge, almost 3 times the average. So let's get into the numbers that sparked that move. The print, as they say.
Right. So the headline grabber was really the earnings beat. Quality earnings, too. Adjusted diluted EPS, it landed at $5.20.
$5.20. Wow, what's the growth on that?
That's 21% growth year over year. And it really sailed past the consensus estimates. Wall Street was looking for something like $4.84 to $4.89.
So a solid beat on the bottom line. But the top line, the sales number, that was a bit different.
A little bit, yeah. A slight miss there, technically. Net sales came in at $1.209 billion. Now, that's still up 17% year over year, which is strong.
Mostly acquisition-driven growth, I assume.
A lot of it, yes.
Yeah.
But it did just edge below the consensus range, which was more like $1.23 to $1.24 billion.
Okay, so strong earnings beat, slight revenue miss. What's the takeaway there? Why did the market focus so much on the earnings?
It really points to the margin story. The market basically decided that the quality of the earnings, driven by margin expansion, was much more important than that tiny revenue miss.
Right, structural improvement.
Exactly. The adjusted operating margin expanded by 130 basis points. That's 1.3 percentage points, bringing it up to 18.6%. Investors see that kind of margin leverage, and it signals the transformation is actually working financially.
Okay, let's unpack where that improvement came from. Starting with that growth engine you mentioned, Acuity Intelligent Spaces, AIS. This is really the core of their tech platform story.
Yeah, this segment was, frankly, explosive. Sales jumped 204% year over year, came in at $255.2 million.
Okay, 204%. But again, how much of that is just bolting on QSC versus the underlying business growing?
Good question, and that's what's encouraging. The organic growth was actually quite strong. The original AIS businesses, Atrius and Distech, they grew 13% on their own.
Okay, solid.
And QSC itself, looking at it year over year, grew 15%. So it wasn't just an acquisition story. The underlying pieces are performing well, too.
Management talks about this AIS segment as a software-adjacent flywheel. Can you decode that a bit? What does that actually mean in practice, unifying data devices?
Right. It's basically moving beyond selling a physical product, like a light or a sensor, as a one-off transaction. By linking the hardware, the data it generates, and the control systems through a cloud platform.
They create recurring revenue streams.
It's exactly. Software updates, services, real-time building insights. The flywheel idea is that more devices generate more data, which makes the software smarter and more valuable, which in turn helps sell more devices and services. It feeds itself.
That makes sense. But what about the profitability of AIS? Especially with a big acquisition like QSC, an adjusted operating margin of 21.4%. That seems incredibly high for a segment integrating a major piece so quickly.
It is high. And it improved rapidly. They mentioned QSC's margins improved by 500 basis points in just 8 months.
How did they manage that? Is there a risk they're cutting corners for short-term gain?
Management attributes it to their core operating system, what they call better, smarter, faster. They essentially plug QSC into their existing playbook for manufacturing, supply chain, efficiency, the stuff they've honed over years.
So applying the core Acuity DNA to the new asset.
Pretty much. Getting QSC's profitability up towards the level of their established, efficient controls businesses like Distech.
Okay, so AIS is the growth story, clearly validating the tech transition. But that narrative only holds up if the foundation, the original lighting business, isn't crumbling. How did Acuity Brands Lighting, ABL, perform?
ABL showed real resilience. Sales were $962.4 million, basically flat, up just 0.8% year over year. But considering management called the overall lighting market tepid, flat is actually a win.
And where did that stability come from?
It was mainly their independent sales network, which grew about 4%. That helped balance out some declines they saw in corporate accounts. But the really impressive part for ABL was Again, the margin performance.
Right. You mentioned overall margin expansion. How much did ABL
A
contribute?
lot. ABL's adjusted operating profit margin expanded by 210 basis points,
Yeah.
hit 20.1%.
200 basis points on flat sales in a weak market. How?
Pure operational discipline, tight pricing controls, and really accelerating the cost-saving efforts, OpEx control that they kicked off back in Q3.
And they're doing this without assuming any help from the market improving.
Exactly. They explicitly said they aren't modeling an economic tailwind. The growth and margin improvement are coming from internal actions and taking share.
And these cost actions, the restructuring, are they temporary fixes or lasting changes?
Management was clear. These are effectively permanent changes to how they operate. Structural improvements, not just short-term belt-tightening.
That's significant. What about external pressures like tariffs? That's been a big theme for industrials.
They've managed that incredibly well, actually. They highlighted a dramatic reduction in China exposure, down about 80% over the last 5 years. That's a huge strategic shift in their manufacturing footprint.
80%. Wow. Proactive diversification.
Definitely. And on the tariffs that remain, they use strategic pricing, generally low to mid-single digits, aiming to keep the dollar impact neutral.
But did it still hit the margin percentage?
Slightly, yes. They estimated about a 50 to 100 basis point headwind to the margin percentage from tariffs, even with the pricing actions. But obviously the productivity gains more than offset that overall.
And they're still investing in growth within ABL too, right? New areas.
Yeah, they called out ongoing investment in new verticals. Things like healthcare, they mentioned a specific brand, Nightingale, plus refuel stations, sport lighting. They expect these to add maybe 50 to 100 basis points to ABL's top line going forward.
Okay, let's quickly touch on capital allocation and the balance sheet. Anything major there?
Pretty standard stuff, consistent strategy. They declared the quarterly dividend, $0.17 per share. And they kept buying back stock pretty aggressively, another 436,000 shares repurchased for about $119 million.
So returning cash to shareholders remains a priority.
Yes. One thing they did note was inventory. These inventory are up a bit.
Is that a demand issue?
They said no, it's driven by two things. One, just the higher dollar cost of inventory because of tariffs inflating values. And two, an intentional move to pull forward some purchases to hedge against future cost increases. They expect it to normalize during fiscal 26.
Okay, makes sense. So that brings us to the outlook. The guidance for fiscal 2026 seemed to be a major driver of the stock move. What do they forecast?
Yeah, the guidance was definitely strong, beat expectations. For the full year 26, they're guiding net sales between $4.7 and $4.9 billion.
And the bottom line?
Adjusted diluted EPS in a range of $19 to $20.50. That's a pretty confident outlook.
Very confident. What are the underlying assumptions? How do they expect to get there, segment by segment?
For ABL, the lighting side, they're forecasting low single-digit sales growth. But here's the key part. They stressed this growth is expected to come from share gains in those new verticals. Their phrasing was telling more us than the market.
Implying they don't need the overall lighting market to grow for them to hit their number.
Precisely. It's about execution and outperformance. And for AIS, the Intelligent Spaces segment, they expect organic sales growth to continue in the low to mid-teens.
Still very strong growth there. Now, what about margins overall? The goal is still expansion, but within AIS, that high-growth tech segment, is there a trade-off? Growth versus near-term profit?
They address that directly. The overall goal is margin expansion for the company.
Yeah.
But specifically within AIS, if they have to choose between pushing for even higher margins right now versus investing to maintain that high teens growth rate,
They'll choose growth.
they'll prioritize investing for growth in AIS, capture the market share while the smart building space is rapidly evolving. Long term, they still see AIS margins going higher, but near term, growth takes precedence.
So pulling it all together, the big picture narrative investors are latching onto is this transformation, moving away from being seen just as a lighting maker tied to construction cycles.
Right, towards being valued more like a building technology platform with controls, software, data.
Why is that distinction so crucial for the stock's valuation?
It's all about the multiple the market is willing to pay. A traditional industrial company might trade at, say, 12 or 14 times earnings because its future is tied to cyclical markets.
Whereas a tech company.
A technology or controls company, especially one with recurring software-like revenue, that flywheel effect can command a much higher multiple, maybe 18, 20 times earnings, or even more.
So the market is rewarding the evidence that Acuity is successfully making that shift. What should investors watch for next to see if this continues?
Keep an eye on continued AI's integration milestones. Are they successfully blending the capabilities of Atrius, Distech, and QSC? And of course, any signs of stabilization or improvement in the broader non-residential construction market would help too, even if Acuity says they don't need it.
And what about monetizing all the data they must be collecting from these smart buildings?
Management sort of tempered expectations there for the immediate term. Over the next year or two, don't expect specific data products to launch.
So how will it show up?
It'll show up first through more software-based revenue streams tied to their controls platforms and by delivering better outcomes for customers using that data. It's about leveraging the data within their existing service and platform structure initially.
And M&A, still looking.
Yeah, they confirm the pipeline is active, still focused on acquisitions that expand their ability to capture and utilize data from built spaces, enhancing that whole smart building ecosystem.
Okay, this whole transformation story, the execution they've shown, it definitely presents an interesting strategic picture. Let's pivot to our "This is not financial advice" segment. If you really buy into this narrative shift, what's an aggressive, maybe even outrageous way to play it?
Right, definitely not financial advice, just speculative thinking here. But if you're convinced Acuity is successfully re-rating as a tech company, and you believe the QSC integration is working and the guidance is achievable,
When the classic move would be?
a pair trade could be compelling.
Okay, lay it out. What's the trade?
Simple structure, go long Acuity, AYI, and simultaneously short a basket of their more traditional peers,
Peers meaning?
other lighting companies, or maybe broader non-residential construction suppliers who don't have that advanced controls platform or seem slower on productivity improvements and tariff mitigation. Companies still firmly planted in the cyclical bucket.
And the rationale behind that.
You're betting on that valuation gap widening further. The idea is that AYI has proven it can generate some growth even in a tough market, that more us than the market, ABL growth, while also compounding high growth in AIs. That combination offers a kind of defensive growth profile.
So the bet is the market keeps rewarding Acuity with a higher multiple for this tech transition.
Exactly. While the pure play cyclical peers remain stuck with lower multiples, constrained by the tepid end market, maybe slower to adapt structurally, you're playing the divergence.
Interesting tactical idea there. So wrapping up our deep dive on Acuity Inc., a really strong quarter and full year, delivering on the transformation promises, boosting margins through efficiency, and guiding confidently.
Yeah, the main takeaway for me is that they aren't just waiting for the market cycle to turn. They're actively driving their own performance through share gains in ABL and rapid growth in AIs.
Which leaves a final thought for you, the listener. Given management's confidence, particularly that claim about ABL growth being more us than the market, how much longer will it take for the broader market to fully reclassify AYI? To stop thinking lighting cycle and start thinking ITOT tech platform?
It's the multi-billion-dollar question, isn't it?
Indeed. And just a reminder, this deep dive does not constitute financial advice. Thanks for joining us.